On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Navigating the investment world is hard, even for the professionals. For everyone else, it's tougher still when the advice comes wrapped in jargon and spreadsheet speak. I've seen analysts talk down a company's prospects but still rate it a buy because their model said it was cheap. Other times, they'll rave about a business but stop short of recommending it because the price looks a bit rich. It's not easy predicting share prices, and things often fall into a grey area. But what are we supposed to do with those mixed messages? Many share investors will have come across these reports on specific companies. They're packed with information and can be a great resource for learning about a business, its growth prospects, and the risks it faces. The job of the analyst behind the report is to become an expert on that company and the industry in which it operates. To achieve this, they'll visit factories and sites, talk to executives, competitors, and customers, while conducting extensive analysis on the broader industry as well. They learn as much as possible about each company's strengths and weaknesses and share these insights with their information-hungry clients. An analyst's report on a company will usually contain a recommendation that sums up their opinion on the shares. The most common terms are the traditional buy, hold, or sell, but sometimes you see the likes of overweight or outperform used to reflect a positive view. Many of these also contain a target price, which represents the price the analyst believes the shares will reach over a certain time frame, which is often about 12 months. Generally, a target price that is above the current share price is accompanied by a buy recommendation, and vice versa for a target price that is significantly lower. When the target price is pretty close to the current share price, you end up with a hold or a neutral rating. Now, everyday investors often zero in on the recommendation and target price, but ironically, these are two things that professional investors tend to gloss over. This group is likely to be more interested in the detail of the report and the nuanced messages within, which might provide a new perspective that they haven't considered. They'll also be curious about what sort of assumptions the analyst has made, and they'll use this expert as an additional information source or a sounding board to cross-check their own views. Professional investors and fund managers are more than capable of making their own buy and sell decisions, and that means they're more likely to judge an analyst on the insights that he or she provides, rather than that analyst's ability to predict whether the share price is going up or down. A huge amount of time and effort does go into valuing a company. Complex financial models are built that forecast future earnings over many years, while potential risks and opportunities are assessed and estimated. Tweak one of these variables and the valuation can shift dramatically. Even the most academically minded analyst will admit that a model is only as good as the assumptions behind it. And no model could have predicted COVID-19 or today's shift in global trade tensions, which shows just how limited these forecasts can be. This makes the modelling and valuation process rather imprecise, and it's as much an art as it is a science. Like the British statistician George Box famously said in the 1970s, all models are wrong, but some are useful. Analyst reports can be very helpful when gathering information and trying to learn about a company. However, as an investor, you do need to take a more holistic view when choosing which shares to include in your portfolio, rather than relying heavily on the recommendations and target prices that you might see in these reports. They can help guide your thinking, but the best investment decisions also weigh up things like leadership quality, balance sheet strength, dividend growth potential, and any strategic opportunities the business might have. Those things can be quite hard to capture in your spreadsheet model. Thanks for listening, team. Let's talk again soon.
For more insights, visit craigsip.com.